Welcome to Thoughts on the Market. I'm Seth Carpenter, Morgan Stanley's Global Chief Economist. Today, I'll be talking about the Fed meeting, where they cut rates for the first time in this cycle, and what it means for the economy around the world. It's Monday, September 23rd at 10 a.m. in New York. The Fed cut rates by 50 basis points, but we did not see a huge shift in this reaction function. Rather, the 50 basis points was to show a commitment to not falling behind the curve, to use Chair Powell's words. From here, the most likely path, from my perspective, is a string of 25 basis point cuts. Powell has again demonstrated that the Fed can move gradually or quickly, depending on perceptions of risk. But for now, judging from Powell or other policymakers' comments, the Fed still sees the economy as healthy and the labor market as solid. But another payroll print of 100,000 or a softening in consumer spending, well, that would tip the balance. So the market debate will continue to focus on the pace of rate cuts and the ultimate landing zone. Our baseline is a touch more front-loaded than the dot plot would imply, with us expecting the funds rate to reach just below 3.5% in the middle of next year rather than the end of next year. The Fed's projections have declines in the target rate into 2026 and beyond, but I have to say the dispersion in the dots that they put up shows just how much consensus is yet to be built within the committee. And as a result, the phrase data dependency, that's not a term that we want to drop from the lexicon anytime soon. The magnitudes of the changes differ, but a comparison that we have made often here is to the 1990s, and that cutting cycle, eventually it paused as the economy stabilized and continued to grow. So there are lots of options for where we go next. Globally, central banks will be adapting and reacting both to global financial conditions like this Fed rate cut, as well as their domestic outlook. Among emerging market economies, Brazil and Indonesia make for useful case studies. With an eye on defending its policy credibility and on market expectations, the central bank in Brazil hiked rates to 10.75% this week, after a cutting cycle and then a long pause. A weaker currency is the external push, but strong domestic growth is the internal consideration, and both of those imply some inflation risks. The Bank of Indonesia cut rates after a strong appreciation in the currency, which lowered the risk from inflation, and it really enabled them to change their footing. Now, for DM central banks, the 50 basis point cut really doesn't materially shift our expectations for what's going to happen. If we are right, and ultimately we get a string of 25 basis point cuts, there's little reason for other developed market central banks to really adjust what they're doing. In Europe, we're waiting for inflation data to confirm the slowdown after the softening of wages that we've seen. So we have high conviction that there's a cut in September, and we expect another cut in December. Now, more cutting by the Fed might lead to a stronger euro, which would reinforce that inflation trend, but I don't think it would be enough to really change the path and prompt more aggressive cutting from the ECB. After skipping a rate move in September, given all the question marks they still see about inflation in the UK, we think the Bank of England restarts their cuts in November. The split decision at this most recent meeting shows that the MPC is not making frequent adjustments to its plan based on small tweaks to the incoming data. And finally, for the Bank of Japan, we expect them to stay on hold until January. The meeting for the Bank of Japan was primarily about communication, and indeed, Governor Ueda's comments did not prompt the type of reaction that we saw at the July meeting. So if we're right, and the Fed's path is mostly like we think it will be, these other developed market central banks don't have to make big changes. So the Fed didn't really fully recalibrate its outlook. Instead, what it did was signal a willingness, but just a willingness to make large shifts with no clear indication that the fundamental strategy has changed. The market implications seem like they could be clear. With the Fed easing amid economic conditions that remain resilient, that should be positive for risk assets. But the Fed is also trying to prevent complacency. And I have to say, uncertainty is plentiful. If for no other reason, we've got an election coming up, and that makes forecasting what happens in 2025 very difficult. Thanks for listening, and if you enjoy this show, please leave us a review wherever you listen to podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.